Hello everybody, I just wanted to go over today some of the capital budgeting Excel problem that we did today during class, and I just wanted to make a video on it. So I'm going to start off as always with taking out all of the sections of the problem that are important. For this problem we do have a template to go off of, so we're just going to fill out the top of this template to begin with. So let's get started. So the finance manager of a fast food restaurant is presented with an opportunity for opening a new location. The company has recently paid a consultant $50,000 to complete a demographic study about the new location. So this is our first piece of information, but it's actually an unimportant piece of information because this consultant was paid $50,000. That's a sunk cost, and so we'll never really need to account for that. Maybe we could put it down somewhere, but it's going to end up being unimportant, at least for this problem, so we're just going to skip right over it. The results indicate that this is a good opportunity. However, since it is close to another location, you expect that there will be a negative effect on the after-tax cash flow of that other location of $100,000 per year. So that is going to be our cannibalization cost. Now, there's no cannibalization cost up here at the top, but there is here at the bottom. So we're going to place a $100,000 cannibalization cost in years 1, 2, 3, 4, and 5. And we're doing this because we're cannibalizing that $100,000 after taxes, so it's after the tax bar here, and it's going to be for all of the years that we have. So that's why we're putting that in. So the company would use land that they purchased 3 years ago for $100,000. So once again, there is no land space, but what we will do is we will put it in here just because that's the book value of the land. Remember, land can never be depreciated. It's just something that's never depreciated. So we're going to have its book value be $100,000. However, they estimate the current value of the land to be $125,000. So if they wanted to sell this land, they could sell it for about $125,000. And so we'll just do this right here. We'll do the gain loss. So they would make $25,000 if they sold that. There will be a tax effect, but we don't know by how much yet. So we're just going to leave that we would have gained $25,000 if we sold it. So we'll keep that in the back of our minds. So they plan to spend an additional $500,000 on the plant and equipment to make their product. So this is going to be the initial investment. So the initial investment will be that $500,000, and the equipment will have a 5-year useful life and a salvage value of $0 at the end of that year. So the salvage value will be 0, and the useful life will be 5 years. Now, this automatically calculated our useful life, so we get $100,000. You could do that manually by just dividing 500,000 by 5, since it is straight line, and so the depreciation will be $100,000 a year. All right, and now it's just saying how much it'll sell every year. That was already input in by the maker of this spreadsheet, so we don't have to do anything with that. So the company estimates that the average bill per meal will be $25. So we'll put that as the price here, so $25, and then we will create, and the cost of their ingredients is 45% of revenue. So we'll just add in a 45%, and the fixed cost per year, that should be coming up. Yep, the company estimates SG&A expenses for the store to be around $600,000 per year. So there we go. The total net working capital is 10% of next year's sales. So 10%. the tax rate is, oh, hold on. We're going to go back to reading. Assume at the end of the 5-year period, the plant will need to be shut down due to an expected change in zoning laws. The company estimates it will be able to sell the plant and equipment for $200,000 at that time. So let's take that down here. We'll be able to sell for $200,000, and the book value at that time we will talk about in a little bit, and I'll explain that because this is a confusing aspect, but we'll get into it a little bit later. So, but that's our sales price. Now, the company has a marginal tax rate of 25%, or 21%, sorry, and a required rate of return of 15%, which is our discount rate. So now we have everything that we need to get started pulled from here, and I'll just make this full screen now and zoom in a little bit more. So hopefully it's a little easier to see now. So we're going to start off by computing our revenue. So our revenue will always just be the number of meals sold, and then we're going to multiply that by the price, and we're going to hit F4 to make the price stay in the same spot so that it'll always reference B2. We're going to pull that across, and now our revenue for each year is being automatically calculated. Now, our cost of goods sold is always 45% of revenue, so we're going to do the same thing with that. We're just going to multiply revenue, or the cell above, by 45%, and once again referencing this cell every time. So just add in those dollar signs or hit F4 to do that. So our gross margin will just be the revenue minus the cost of goods sold. We will copy that all the way across, and there we go. Now our fixed costs per year, that will just equal B4. Once again, F4 to make it always the same, and copy it all the way across. Our depreciation expense, once again, that's another thing that is fixed, so we're just going to F4 that one as well and copy it across to all of the cells. Now, our pre-tax profit is a little different on each of these, and actually, in order to make things a little easier, we're going to make our fixed costs per year, actually up here, we're going to make them negative, and we're going to do that negative, and we're going to edit this, the value if true, the value if false, we're just going to make it negative. So this will actually, no, we're not going to do that because then it'll just mess things up later. So we'll just make this negative. Sorry for the bit of confusion, but essentially what we're doing is we're going to make this 600,000 and this 100,000 negative just so we can get a little bit of an easier equation, not search, sum. So we're going to just sum these three. Now, I'm going to make everything a little bit easier on us. So now this is our pre-tax earnings before income tax, or our pre-tax profit. So now our taxes are just going to equal our income times the tax times the negative tax rate. So why are we using the negative tax rate? Well, the reason I at least like to do negative tax rate is because your taxes are always going to offset or go against your profit. So if you lose money, then you're going to save money on taxes. If you make money, then you're going to lose money on taxes, or you're going to lose cash at least. So that's how we do that, and I always just like to do negative sign before my tax rate to make things nice and easy. So NOPAT, that was a little confusing, but NOPAT is just your your after taxes income. So we'll just, once again, we'll sum the pre-tax and our after-tax income, and we'll copy it across, and our tax costs. So that will give us our NOPAT. Now our depreciation expense needs to be added back. So once again, we'll just add back depreciation, copy it all the way across, and there we go. Cannibalization has been put in earlier, so that's great. And then we're going to get our cash flow impact from change in net working capital. So let's go down here. So net working capital, this is a header. So we're going to just do total net working capital. And so total net working capital just equals next year's sale, next year's revenue, times 10%, which is right there. And we're going to just F4 that, and then we're going to get that amount. And we're just going to pull this all the way across. And now this is not necessarily true all the time, so be a little careful. But at least in this example, it was okay to pull all the way across, because when we go into revenue in what would be the year 6 column, there's a 0 there, or there's really nothing there, but it calculates it like a 0. And so in year 6, we need $0 because we're going to have 0 sales. So it made the total net working capital in year 5 0, or at the end of year 5 0, because we need no net working capital in the next year. And if you're a little confused about how this net working capital works, essentially every year we need a certain amount of inventory or a certain amount of equipment, cash, stuff like that on hand. Actually not cash, but like accounts receivable, stuff like that on hand in order to satisfy our needs in that coming period. So we just did it as 10% in this case. So we're going to just take 10% of the 1 million, 10% of the 1.5 million, and all the way across, and that'll give it. But then at the end of our project, we need no money or no net working capital anymore. So we just get rid of it. So, or it just becomes 0. And so we'll see how we calculate that here in a second. So the change in net working capital in year 1 is just going to be net working capital, but before it's going to be the change in net working capital is going to be, or for year 1, the change is going to be year 1's net working capital minus the net working capital in year 0. And we're going to copy that all the way across. And now this one gets too big. And actually, I'm going to get rid of all of the decimals. I just don't like the look of them. And then the cash flow impact, we're just going to do negative sign and the above amount. And this is just because if our net working capital increases, that means we need to have more money tied in non-cash accounts. And that's not good for our cash. Well, it's not good or bad, but it decreases our cash. If we have $100,000 more stored away in inventory, for example, then we need $100,000, or then we'll have $100,000 less in cash. And then at the very end of the project, we'll need to store no more stuff in cash. And so it'll just all come back to us as cash. So because our inventory will go away, we get the whole $250,000 back in cash. And all we're going to do now is we're going to just hit, we're just going to set the cash flow impact equal, and then we're going to copy it all the way across. So that's our cash flow impact. Now we're going to get into kind of these special cases. So our investment in plant and equipment. So at the very beginning, the investment in the equipment is going to cost us the $500,000, and that's actually going to be negative. So we'll just make it negative right there. And then the opportunity cost of the land. Now, this is where things can get a little confusing. So the land, some people might say, is a sunk cost. We've already bought the land, but that's not true, because we could sell the land this year, and using that land, we could make cash. That land could give us cash. So what we're going to do is we're going to calculate the cash that we could have got had we sold the land just this year. So let's calculate the tax effect. So we remember we're only taxed on the gain or loss on the sale. So we're doing the 25,000 times the negative tax rate. So we get a tax effect of negative 5,200. And then we're going to just sum. We're going to sum the book value with the gain and the loss and the tax effect. You can also just do the tax effect, add the sales price and the tax effect together, and that'll give you the same answer. However, I kind of like to think of it more as we have the book value of the asset, which we're going to get all in cash, and then we're going to gain some additional cash, but that cash we don't actually get to hold on to. It has to be paid out as tax, and then that's going to give us our net cash flow. So that's at least how I like to think of it. However, that doesn't make sense to everyone. And if that's one of you, don't worry. Just subtract the tax effect from the sales price. Actually, don't subtract in this case because it's already negative. But if you kept yours positive, then do subtract that. All right. Now, that's that. So we're just going to set this equal. And this does need to be negative. So our cash flow would be positive if we sold it this year, but we're giving up this cash flow, so we have to make it negative because that's just how we have to do it. In this particular example, since we're foregoing that cash flow in year 0, we don't get that cash, and therefore it's negative. If that wasn't clear, just ask me in class or whatever, and I'll be able to go over it. So the sales price then for the sale of the asset. So this is a little difficult at first, but actually the book value is 100,000. Now this is confusing to some people because the book value, as stated in the problem, was 0. And we can go here, and we can see that the company, where is it? Salvage value of $0 at the end of the 5-year period. Or it's right here too, the salvage value is 0. But remember, they are going to sell both the plant and the land that the plant is on. So that land does still have that book value of 100,000, and that book value will never change because remember, land cannot be depreciated, and just because we could get $125,000 for it, we don't put that unrealized gains onto our book value. So we just leave it how it is. Now, once again, we're going to take the 200,000 and we're going to subtract the $100,000 from it. Now, this is our gain that we would gain once we sell. We're going to multiply that by the negative tax rate, and we're going to get negative 21,000. Now, our net cash flow will once again be sum of all of these items, and we're going to get that our net cash flow would be $179,000 when we sell this product, or when we sell our land and equipment. And this makes sense because we have a book value of $100,000, and we'll get the full amount of that money in cash. Then we're going to also have profit of $100,000, but that $100,000, we're going to lose 21% of it, or $21,000 to taxes, and therefore we're going to get a net cash flow of $179,000. And so that will be our the amount of cash that we're going to make once we actually sell. So now we're going to just calculate our free cash flows. This will just be real simple. We're just going to sum up everything in this entire column. Since we already made sure that everything is in the right format, hold up, besides cannibalization needs to be negative. So I'll just make that negative. And now everything is, the correct. And so what we're going to just do, is we're going to do the NPV, and we're going to get the rate. So our discount rate is 15%, and we're going to take the values from year 1 to year 5. And we don't include year 0 in the NPV calculations. However, we do add them in at the end. And we get our net present value to be $68,823. And now we're going to just do our internal rate of return. We're going to select all of our values. And I tend to like to guess just the discount rate, because odds are it's going to be near the discount rate most of the time. So I'm going to guess the discount rate. It's going to show up as 0. However, it is not 0. We're just going to switch it to a percentage, increase it by 2, maybe 1 decimal place, and we get 17.19% internal rate of return. And so, judging by this, the fact that we have both a positive net present value, meaning that if we took on this this investment, we would make the equivalent of, or we would have the equivalent of $68,823 today, as well as the fact that the internal rate of return is higher than our discount rate. This is a good investment, and the company should take this. So hopefully this helped you all out. Feel free to comment if you have any questions, and good luck.